Well, welcome everybody. We are dealing with chapter, what are we dealing with? Chapter 8 today. Hey guys, we're counting down the weeks. It's happening. We're slowly towards the end of, getting closer to the end of the semester. These are live lectures with a financial accounting, the book is Spiceland, and I do post these to YouTube. So anybody and everyone can benefit from them. So guys, we are going to start talking today about current liabilities. And we're going to understand what the difference is between current liabilities and long-term liabilities. And then we're going to get into some various topics, such as talking about contingencies, warranties, and a big piece in this chapter is talking about employee and employer payroll liabilities. So we're going to get started if nobody has any questions. So what is the difference between a current liability versus a long-term liability? A current liability is due within 1 year of the date today, whatever that date is, or an operating cycle. A long-term liability is a liability that is due in more than 1 year. Now, they always put in the word operating cycle. Honestly, most businesses run in a fiscal year, but the operating cycle can be an operating cycle for some firms where from when they perform the activity to produce the revenues and sell it and collect the cash, if something takes longer than a year, then they can use that specific company's operating cycle. But for purposes of everything I've ever done, I've only worked with companies who operate on a fiscal 12-month cycle. So in this area right here, we're dealing with current liabilities of Southwest Airlines. So you see how they break them down: current debt, accounts payable, monies that they owe vendors, and then it shows other current liabilities. So guys, here we're going to start. Which of the following is typically considered a current liability? What do you guys think?
It's payable.
What do you think? It can't be prepaid insurance because that's an asset, right?
No.
It can't be accounts receivable because that's an asset.
To payable. A.
Salaries payable would be the correct answer. Current liabilities are payable within 1 year. The reason the mortgage payable due in 30 years, that's a long-term liability. It's over 1 year. So we're going to look at how we go about accounting for notes payable and interest. A note payable is a note that's signed by a firm promising to repay the amount borrowed plus interest. Interest on notes is calculated as by taking the face amount of the note times the annual interest rate times that portion of the year we're trying to calculate the interest for. So in this case, let's say Southwest Airlines borrows $100,000 from Bank of America on September 1st, 2022 by signing a 6% 6-month note. So when the note is originally taken out, all we do is we receive the cash for $100,000 and we credit our notes payable for $100,000. That's all that's happened on September 1st. Now, the year-end adjustments, I'm just going to try to get this thing to work. I don't know why I cannot get this. It's just driving me nuts. Let me try it this way. Good. Sorry. There. Sorry, guys. So what happens then at the end of the year when we need to create an adjusting entry for the interest payable? It's at that time we will show the interest expense showing 100,000, which is the note balance, times the annual interest rate at 6%, times 4 months out of 12 months. Since this interest rate is always an annual amount, we have to take it accordingly to the months we're accruing. Since we started in September, we're accruing September, October, November, and December, 4 months. So 100,000 times 6% times 4 months out of 12 months is $2,000. And you see here, we're not paying it now. We're just showing it. We're going to pay it in the future. So we create a credit to interest payable, which is a liability, for $2,000. This is at the end of the year where we report the interest that has been incurred, but it's not been paid yet. It's not going to get paid until March 1st. So when we finally repay the note, we're going to debit our notes payable. Then we are going to debit our interest expense. Then we're going to, oh, and that interest expense is for the 2 months of 2022. Then we're going to debit the interest payable that we owed from the previous year. And then we credit our cash of 103,000. Does that make sense? Okay.
Where did you get the 2 months in the interest expense?
I'm sorry, what?
Where did you get the 2 months out of the 12 months?
So
with the interest?
remember, this loan was a 6-month loan. It was taken out September 1st. So there were 4 months in at the end of 2022. Actually, this shouldn't be the end of 22. This should be 23, dummy me. Sorry about that. There. So basically, the note is a 6-month note. That is why it's only 2 months in 2023, because we accrued 4 months in 2022.
We're not actually counting March. We just report in March.
We're repaying the whole note in March. So remember, we took it out September 1st.
Right.
We took out it September 1st, and we showed when we took out, we just recorded the cash and the notes payable.
Mm-hmm.
By December, we had to show the 4 months of interest that was accrued. And then March 1st, we only had 2 months in 2023 to show the interest expense. On March 1st, we're paying everything back, the note, the
And the
interest we
interest,
accrued in
okay.
2022, and the interest that we show for 2023.
Thank you.
Now, remember, we record interest in the period in which we incur it rather than in the period in which we pay it. That's the whole purpose of this accrual accounting, is we record it when it happens, not when we necessarily pay it. So guys, I want everyone to attempt this. Now, how many are online? Like 8 online? I want y'all to do it too, okay? Hey, what do you guys think?
I got B.
You've got B? Anyone else? Anyone else? B is right. So basically 10,000 times 5% times how many months do we have? October, November, December, 3 months here out of 12 months is 125 bucks. Let's look at this problem here. Eskimo Joe's, designer of the world's second best selling t-shirt, borrows 21 million cash on November 1st, 2022. Eskimo Joe's signs a 6-month, 7% promissory note to Stillwater National Bank under a pre-arranged short-term line of credit. Interest on the note is payable at maturity. Each firm has a December 31st year end. We're going to prepare the journal entries to record the note for both sides for the adjustments we're going to do on December 31st and then paying it on April 30th. So to initially take out the note, what Eskimo Joe's will do is debit cash for 21 million, credit notes payable for 21 million. Stillwater Bank's on the other end. They're going to debit notes receivable for 21 million and credit the cash for 21 million. Okay. Now, in December, we have to show the interest that's accrued. For Eskimo Joe's, it's going to be interest expense and a credit to interest payable. It's 2 months we're accruing for. So 21 million times 7% times 2 months out of 12 months is 245,000. But Stillwater Bank is going to debit interest receivable because they're not going to receive it yet, and credit the interest revenue for 245,000. Okay. Now, when the note is paid off on April 30th, it's at this time we're going to show January, February, March, and April's interest. So for Eskimo Joe, we calculate that interest in the next year by taking 21 million times 7% times 4 months out of 12 months, which is 490,000. And then we take that interest payable that we wrote on December 31st and debit that because we're paying it all now. We're paying off the note payable, the interest expense for the first 4 months of 2023, we're going to debit the interest payable because we're paying it now. And we credit cash of 21,735,000. Now the bank is receiving that cash. So we debit the cash. We then credit the interest revenue that it's earning this year, the 4 months. We credit the interest receivable because now they're finally receiving it. And we credit the note receivable because it's not a note receivable anymore. They've paid it. Any questions on this, guys?
I just want to try it with one of like our examples on the
We're
homework. or
going to have some
something.
more problems here, honey.
Yeah, okay.
Okay, so now there is something called a line of credit. This is another type of current liability. A line of credit is an informal agreement, usually between a bank, where it allows a company to borrow up to a certain amount. It's all been prearranged. It's similar to a notes payable. Now, commercial paper is different in that it's not related to a bank. It's one company borrowing money from another company. It's usually short term. And generally speaking, since the interest rate, since there's usually an incentive to borrow money to this company because they might be in a supply chain and one person needs to get a product done before it moves on to another company. So there's usually a personal incentive or a company's incentive to lend that money. And it's generally at a lower interest rate. Okay. Now, accounts payable, we've known about, we've talked about before. This is amounts owed to suppliers of merchandise or services. And sometimes accounts payable is also known as trade accounts payable. So that is something we have dealt with in the past. And mostly we call it accounts payable, but it can be known as trade accounts payable. So now we're going to get to the one of the pieces of importance here in this chapter is related to payroll. So payroll happened for employees and employers. Now the employee has to have federal and state income taxes taken out of their paycheck. State, if they live or work in a state that has state income taxes, which most of them do apart from about 4 or 5. And then an employee has to take out their share of Social Security and Medicare taxes, and then possibly other deductions for maybe some benefits, health, dental, disability, life insurance, retirement plans. Now, the employer is required to pay what's called federal unemployment, FUTA, or state unemployment, which is called SUTA. Also, the employer must match the amount of Social Security and Medicare that is coming out of the employee's checks. The employer also has to match that amount. And then any shares that the employer pays for benefits come out of the employer costs and retirement. So the federal and state income taxes just really vary depending on individuals' situations. But the FICA tax is made up of Social Security, which is 6.2%, and Medicare, which is 1.45%. So I don't want to get into a lot of specifics on this, but generally Social Security is capped. I think this year it's at about 148,000, but Medicare goes on forever and ever. And then Again, employees may have certain things that they contribute to, so they may have other things that are being withheld from their checks. So employers have to match that 6.2 and 1.45%. So whatever the employee has taken out, the employer has to match that amount also. And employers pay the FUTA and the SUTA and any other fringe benefits. So here we're going to look at an example. This one shows Hawaiian Travel Agency has a total payroll for the month of January of 100,000 for its 20 employees. It shows with that 100,000, the federal or the employees have taken out federal and state taxes of 24,000. Health insurance premiums that were paid by the employer are 5,000. The employer paid contributions to a retirement plan of 10,000. The FICA rate, 7.65 between Medicare and Social Security. And then the federal and state unemployment tax rate is 6.2%. So the first thing we're going to do is look at what would be the journal entries to report the employee salary and withholdings. So we're going to show a salaries expense of 100,000. We're going to credit income tax payable of 24,000. We'll credit a FICA tax payable out of the employee's paychecks of 7650. And then salaries payable, which ends up going into the individual employee's bank accounts, 68,350. So this would be the first piece of recording the payroll. Then the next piece that we'll look at is the employer benefits. So we'll look at the debit our salaries expense. We'll credit an accounts payable for the health insurance. We'll credit an accounts payable to the retirement plans. But we show this under salaries because it still is a cost of having employees. Then the last thing we'll look at is looking at the employer's payroll taxes. So what we'll do here is we will show a debit to payroll tax expense, and we'll credit our FICA tax payable. Remember, the same amount that the employees had withheld, we have to match, 7,650. And then we credit our unemployment tax payable of 6,200. It gave us those figures in the previous slide. In a nutshell, that's how we record employee-employer payroll taxes. Remember that FICA tax, that Medicare and Social Security are paid not just by the employee, but also the employer has to match it. Okay? So guys, I want you guys to look at this one. Which of the following items is paid solely by the employer? What do you think?
Let's see.
Awesome. It is. Employees do not pay federal and state unemployment taxes. They may receive unemployment income, but it is the employers that must pay the federal and state unemployment. A little tidbit. It was interesting. I was trying to hire an individual to work for me for 10 weeks during tax time this year. And this individual said, sure, I'll work 10 weeks because then I can file for unemployment the rest of the year. And I said, no, you can't. I'm letting you know it's seasonal. You can't do that. He goes, oh yeah, I can. So I called the unemployment office. I will say in 35 years of doing, having a business, I've only once had someone file for unemployment, and it was a legitimate deal. So I called the unemployment office and I said to the lady, you know, I told her my story. And she said, well, of course he can. It's not his fault you're only hiring him for 10 weeks. Needless to say, it was very disappointing to me that someone can literally work for 10 weeks and then claim unemployment as though they can't find another job. I mean, it's meant to be so when you need help, you know, it's helping you to look for another job, but that people can get by with that was just kind of frustrating because I end up paying for it. Sorry, you heard too much, but sometimes it's helpful to hear a little scoop. Okay, moving on. Here we've got a problem. The following selected transactions relate to the liabilities of Rocky Mountain Adventures. They are negotiating a revolving line of credit. They arrange for a 3-month bank loan of $5 million at 7% interest payable at maturity. And then on May 1st, they pay the note. Record these entries. So what we're going to do here, whoops, I'm going to have you guys all attempt this. Okay. I give you 2 minutes to attempt it. Okay. So let's look at this. When they first negotiated a revolving credit line and they got approval, there is no journal entry for that. Nothing else happened, but just they signed a contract or agreement. But when in February 1st, they needed to borrow $5 million, we debit our cash and we credit the notes payable. Then when they paid it back 3 months later, it's at that time we debit the notes payable for $5 million. We debit our interest expense, $5 million at 7% interest rate for 3 months out of 12 months, which is $87,500, and we credit our cash. Okay, guys, here's one for payroll. Aspen Ski Resorts has 100 employees, each working 40 hours per week and earning $20 an hour. Although the company does not pay any health or retirement benefits, one of the perks is free skiing on their days off. Federal income taxes are withheld at 15% and state income taxes at 4%. FICA taxes are 7.65% of the first $118,500 earned per employee, and then 1.45% thereafter. Our unemployment taxes are 6.2% of the first $7,000 earned per employee. So we basically need to compute the total salary expense, the total withholding from employee salaries, and the actual direct deposit of payroll for the first week of January. Then we'll compute the total payroll tax expense that Aspen will pay for the first week of January, in addition to the salary expense and employee withholding. And then we're going to talk about how Aspen should account for the free scheme. So how do we calculate the payroll? We've got our 100 hours times 40 hours a week times $20 an hour, 80,000. They told us to withhold federal income taxes at 15%, which would be $12,000. The state income tax is to be withheld at 5%, which is $4,000. And then the FICA taxes are 7.65%, so that's $6,120. So all of those withholdings total up the 12, the 4, and the 6120 to $22,120. So if we take the salaries of 80,000, subtract the 22,120 withholding, our actual direct deposit is 57,880. Now, to show the employer side, the employer also has to take the FICA taxes and match it, 6120. And then the employer also has to pay unemployment taxes at 6.2%, 4960. So the total payroll taxes for the employer in January is 11,080. And then last, the company doesn't make an accounting entry to record the free skiing given to employees on their days off. No additional costs are directly incurred by the company to provide this benefit. And so there's nothing we need to do here.
That's considered a fringe benefit, right?
I'm sorry, what?
That's considered I think it said fringe benefit.
A fringe benefit. It's a benefit, but it's not that significant.
Right.
Okay. Now, there are some other current liabilities we'll address. One that you are familiar with is called deferred revenues, where it's basically a liability used to record when cash is received in advance before we provide a sale or service to a customer. We always debit the cash and we credit that deferred revenue account. There's also sales tax payable. When sales taxes get collected from customers by the seller, and we need to turn around and pay that to the appropriate authorities. And then there's also a current portion of long-term debt. So long-term debt is payable in excess of the year, past the year. But the current portion of that long-term debt is that portion that's going to be paid during this current year. So deferred revenues. When a company receives cash in advance, it debits cash and it credits the deferred revenue, which is a liability account. Here's an example. Apple sells iTunes gift cards to a customer for $100. What happens is Apple will debit the cash and credit the deferred revenue of $100. When it finally earns that revenue, then the company will debit the deferred revenue account and credit sales revenue. So if a customer then downloads $15 worth of music, it's at that time we debit the deferred revenue and we credit the sales revenue. In states where they're required to collect sales tax on specific purchases or services. What happens is when the company collects the tax, so in this example, you purchase lunch for $15, but they charge you sales tax of 10%. So the company actually collects $16.50. But the revenue portion is only $15. The sales tax that's payable to the state is $1.50. So no, it's not all revenue. It's the portion that's revenue and the other portion is credited to sales tax payable. Remember, sales tax that's collected from customers is not considered an expense. It's a liability that needs to be paid to the government. And that's one thing. When people do not remit that sales tax, boy, do they get in a lot of trouble. It's not their money to hold on to. Then that current portion of long-term debt is that debt that's going to be paid within the next year. So if we have a 20-year mortgage and we show the amount that is within the next year payable on it, that's the current liability portion. And then that amount after the next year is going to be the long-term liability portion. Know that long-term obligations get reclassified and shown the portion that's the current liability gets reclassified to a current liability when that amount is what's going to be due in the next year. So a note payable that matures in 10 years, a note that matures in 10 years is reported as a long-term liability for the first 9 years. But then in that 10th year, when it's going to be paid off, it's transferred over to a current liability. All this stuff really makes sense. It's pretty straightforward. Okay. So Apple is the #1 online music retailer through its iTunes music store, and it sells gift cards in $15, $25, and $50 increments. Assume Apple sells 21 million in iTunes gift cards in November, and customers redeem 14 million of the gift cards in December. We're going to show the advanced collection of 21 million in iTunes gift cards for November. And then we're going to show the revenue earned in December when 14 million of those gift cards get redeemed. And we're going to look at what the ending balance is in the deferred revenue account. So when they receive the cash on the gift cards, we debit 21 million cash and credit the deferred revenue of 21 million. In December, when 14 million were redeemed, we're going to debit that deferred revenue and credit our sales revenue for 14 million. So do you see, if we started with 21 million and 14 is redeemed, that our net ending balance in the deferred revenue account would be 7,000? Does that make sense? Yes? No?
Yep.
Good. Okay. So now we've got here, it's just showing how Southwest Airlines shows that current portion of long-term debt on the books. So it will say specifically current portion of long-term debt, and then it shows the long-term debt. Okay. Excuse me, just. Okay. How about this one? A home improvement store sells some merchandise to a customer. The price of the merchandise is $200 and the sales tax rate is 6.5%. How much would be recorded in the sales tax payable account? What do you think, guys?
Is it A?
A? What do you guys think? Yes. The $200 times 6.5% is $13. Now we're going to look at contingencies. A contingent liability is an existing situation that's really not clear. It's uncertain, and it could result in a loss dependent upon some future event. So you don't always know, but there are ways in which we determine how to handle it. Here's the deal. If the likelihood of this contingent liability is probable, and if we can reasonably estimate it, we're going to report it. We only record it in the books if it's probable and the amount is reasonably estimable. That is it. If it's possible and we can reasonably estimate it, we'll just put a note in the financial statements about it, but we don't do anything else. If it's remote, we ignore it. Everything's remote. We could have an earthquake in Minnesota today. That's a remote chance. Everything's, we don't do a thing with anything remote. So remember, if it's probable and we can reasonably estimate it, we're going to record it in the books. If it's probable, but we don't know how to estimate it, we just make a disclosure, and we'll make a disclosure if it's reasonably possible, but we do nothing if it's remote. No, only probable and reasonably estimated. We should debit the loss and we credit our contingent liability. So let's look at this example. Pacific Cruise Lines is a defendant in litigation involving a swimming accident on one of its 3 cruise ships. For each of the following scenarios, determine the appropriate way to report the situation. Explain your reasoning and record any necessary entry. So if, I gotta fix this word, if the payment occurring is probable, not probably, okay. So if the likelihood of a payment occurring is probable and the estimated amount is 1.3 million, are we going to do something? Yes. We're going to debit our loss and credit our contingent liability. Okay. Debit our loss, darn, and credit our contingent liability for $1,300,000. Okay. If the next one says Pacific Cruise Line, oh, let me just read it. The likelihood of a payment occurring is probable, and the amount is estimated to be in the range of 1.1 to 1.6 million. In that case, we're going to record it, but we're going to use the lower figure, the 1.1 million. Okay. Then we had one that said the likelihood of payment occurring is reasonably possible, and the estimated amount is 1.3 million. We're not going to record that. We're just going to put a disclosure or a note in the financial statements regarding it. And then the last one said the likelihood of a payment occurring is remote. Well, there's nothing we do there. We don't do a thing if it's remote. Disclosures are not required. Okay. Now, one thing we're probably all aware of has to do with warranties. Warranties are usually handled for most items that relate to automobiles, RVs, computer equipment, everything. So in many companies, they know based on past history what the warranty costs are going to be. So in this example, let's assume that warranty costs based on history is estimated to be 3% of sales. December sales are 1.5 million, and customers make warranty claims of 12 million in January of the following year. So what we're going to do is we'll debit our warranty expense, 1.5 times 3%, 45,000, and we credit our liability. Then when we actually have claims, that's when we debit our liability and we credit our cash. Okay, so we debit the warranty liability when we actually have a claim, and we credit the cash. Okay, now what's left in the warranty liability account after those payments in January would be 33,000. We started with 45,000. We used up 12 of it, and we have 33,000 left over. Okay. Okay. Some students think the balance in the warranty liability account is always going to be equal to the warranty expense. But remember, the warranty liability account gets increased when the estimated warranty liability gets recorded. But then over time, as true claims come in, it's going to be reduced. Okay. Now, here we have computer wholesalers. They restore and resell notebook computers. It originally acquires the computers from corporations upgrading their systems, and it backs each notebook with a 90-day warranty. Based on previous experience, computer wholesalers expects warranty costs to be 6% of sales. Okay. Sales for the month of December are 600,000. Actual warranty expenditures in January of the following year were 13,000. So it asks us a couple things. Does this situation represent a contingent liability? Yes, because it's probable that costs are going to be incurred and they can estimate it. Record the warranty expense and warranty liability for the month of December based on 6% of sales. So remember, we need to record it in December because we always offset our expenses with the, or we offset the revenues with the costs that helped to incur them. And so we have to show the expense in the same period. So 6% based on 600,000 would be a debit to warranty expense for 36,000. And we would credit, excuse me here, let me just fix this. And we would credit our warranty liability for 36,000 also. Okay, does that make sense? Then when actual warranty work happens, that's when we will debit our warranty liability for 13,000. What, it's just driving me nuts. These things are all messed up. I apologize. Okay, 13,000. And then we would credit our cash for also 13,000. Okay? That makes sense. After the end of that work done in January, our warranty liability would show a credit for 36,000. And then when the payment happened, we debit the 13,000. And then we credit the warranty liability for 23,000, or that would be our remaining balance. Okay. Got it? How about this one? Which of the following statements is true with respect to warranty liabilities? What do you guys think?
Is it D?
Second here. So you think it could be D. Any other ideas? So basically here, which of the following is true? Warranty expense needs to be recorded in the period the warranty repair is made? No. We're going to record it in the period that the revenues were shown. So we debit our warranty expense and credit our warranty payable. The warranty expense account balance will always equal the warranty liability account balance? No, not at all. The warranty liability account is debited as actual repairs are made. That is true. You see, in here, when an actual repair happens, we reduce our liability and we credit our cash. Okay. How about this one? During its first year of business, Oceanic Inc. has sales of $300,000 and pays warranty claims of $10,400. Oceanic offers a 1-year warranty and anticipates that warranty costs will total 5% of sales. What is the balance of Oceanic's warranty liability account at the end of the year? Anyone?
Is it B?
Is it B? Okay. Awesome. So Oceanic has $300,000 of sales at 5%. The warranty is $15,000. So we would debit at that time, warranty expense, $15,000, credit warranty liability, $15,000. And then it had claims of $10,400 against it. So the $15,000 liability minus our $10,400 claims shows a balance at the end of the first year of $4,600. We never report contingent gains, never. So even though they may suspect a contingent gain, you do not record a gain until you have it in your hand. Until the gain is certain, you don't record it. Unlike contingent liabilities, contingent gains are not recorded until the gain is certain. Now, I'm going to let you guys deal with these ratios. You've got some various liquid ratios. You always hear about current ratios. That's probably one of the biggest. It's just the ability to pay your debts as they come due. So I want you to look at those. And I believe that is pretty much the focus of this chapter. It's pretty straightforward. So I want to go through the homework, but does anyone have questions regarding this? Any questions? Okay, so here's the deal. Let's go look through the homework. And